Welcome to The Pulse by GRESB. Today, I'm your host, Parag Cameron-Rastogi. I'm Director of Real Asset Analytics at GRESB. We're going to be talking today about physical climate resilience in the context of the global logistics and industrial sector. I'm very happy to be joined by Matt Clifford, all the way from Australia, where he is Head of Sustainability and ESG, Asia Pacific at Cushman Wakefield. Thank you for joining.
Thanks for hosting.
A lot of what you're going to talk about today comes from this excellent report you have published around the global risk profile of logistics and industrial. Could you talk a little bit about what the report contains?
Absolutely. So the report is Climate Risk, Logistics and Industrial Global Outlook, and it pulls together 7,000 real buildings around the world from 300 industrial submarkets across 120 global cities. So it's all of the biggest logistics and industrial investment locations. And what we've done was assess each and every one of those buildings through the lens of climate risk to understand how does risk show up in a given location? How does it change around the world? What are the parameters to look at? There's some general takeaways that you can get around certain locations being particularly flood prone or fire prone, heat stressed. But really what the takeaway was that there's no substitute for local data. Looking at an individual building, you might find quite different results from a similar building that's literally on the other side of the road. So local data when it comes to climate risk is really critical.
So diving in, let's talk about why we are talking about logistics and industrial today.
I think if there's one asset class within real estate that's shaped investment decisions and capital planning over the last several years, it's logistics and industrial. We've seen offices and retail and some other asset classes, unfortunately, go through a period of decline. That'll come back at some point. But what's filled that gap has been logistics and industrial. A lot of that's driven by major trends like e-commerce, last mile logistics, the real-time and near-time delivery lifestyle that we all live. Sort of in the back of COVID, I think COVID was a huge influencer, but COVID's come and gone. And guess what? L&I is here to stay. I think in the last couple of years, we've seen an uptick around about 40% of investment dollars going into this asset sector alone.
Yeah, it's interesting also that if you look at the GRESB submissions, we've always been dominated by office and retail, with residential usually coming in third, but logistics and industrial really climbed up in the last few years, and it formed a substantial portion of assets submitted to GRESB now.
It's also probably bears mentioning that an individual industrial asset typically has a lower value by itself. So compared to an office building, that might be several hundred million or $1 billion in USD terms for a single asset. An industrial facility is often many, many times smaller than that, but there's a lot of them. So when we look at the investment dollars that are shaping our world and we're seeing the scale of L&I growing, that's a lot of assets and there's a lot of data that goes on with that. So for sure, GRESB should be paying attention. I'm sure you are already.
Absolutely. And I think what's interesting is, since we wanted to talk today about physical climate risk, which is a growing subject in GRESB, it doesn't have quite the quantitative treatment that, say, energy and emissions do. But we know it's a priority for us. We're talking about it. We hosted a roundtable just last year at the London Climate Action Week. So physical climate risk in general, if you could tell me a little bit about how you advise clients, but specifically why that would be different for logistics and industrials.
Definitely. And just on that topic of quantification, I guess I've been in this industry long enough that I remember when carbon accounting was a new thing and people were still scratching their heads saying, hey, I'm not quite sure what that means, or I'm not really sure how to quantify other parameters of environmental performance. We're still at its infancy around climate risk, but in 4 or 5 years' time, I believe we'll all have a far greater ability to quantify physical climate risks as well as other factors. Just in terms of what it is, it might be a kind of tricky question to say, how could climate risk impact physical real estate? What are the things that are likely to occur? It could be things like storms, floods, fires, rain impacts. These are the kind of natural forces that unfortunately are getting more prevalent and sometimes more powerful around the world because of climate change. And they have a real impact. We've seen many, many examples in recent years where cities have flooded, buildings have burned down, or have been at risk of being hit by some of those impacts there. So that's the first parameter, to understand what are those risks? How do they show up in real estate now? And how are they likely to show up over time? And the great thing is that a lot of this is data driven. So you can actually model these impacts down to a very granular view on an individual building, an individual part of a city, an individual plot of land, to say, what are those impacts going to look like now, leaning on the best climate science that's available in the world, and then relating that back to the physical form, real estate form or built form, to say, how are those impacts likely to be felt? How is that different when it comes to logistics and industrial? First part is to say that those impacts can happen in any asset class. What we've often found is logistics and industrial facilities tend to be built in, let's say, slightly less favorable locations. It might be along the side of a motorway or a river, a canal, could be next to the train lines, next to the port. And that's usually due to pricing and availability of land. Industrial tends to be built on the outskirts of cities, not in the downtown areas. So what that means is that's land that might be more exposed in some cases. Logistics industrial just covers a much broader area. I'm based here in Sydney, as you mentioned. The downtown area of Sydney is 20 blocks in any direction, give or take, versus the logistics and industrial catchment is probably 50 or 100 kilometers in any direction. So we're talking about much, much larger areas for logistics and industrial. And it means that that data-driven view is so important.
That's right. Yeah, I think it's important to remember also that when we cite these warehouses and logistics and industrial facilities sort of out of sight, so that's a deliberate choice, right? We don't necessarily want industrial facilities in our backyard, but that doesn't make them any less critical to our functioning as an economy, as a society.
Yeah, that's right. I think in logistics industrial, it's a useful umbrella term, but you could break that down further to say it could be anything from a warehouse filled with boxes that's somebody's Amazon delivery. It could be cold storage for food, last mile delivery and instantaneous deliveries there. Could be a high-tech manufacturing robotics facility. It could be a data center. It could be all sorts of different things. So these are critical assets, critical functions go on in them. So the ability to operate safely and effectively, and for people to go to work and to come home safely and effectively, not be impacted by these physical risks, that's really important. And again, the great thing there is that this is information that you can model, you can get quite granular views, and there's a lot that can be done that is quite cost effective to improve the resiliency and the adaptation ability of these assets too, to protect, not just to be aware, but also to do something meaningful to improve the risk profile.
I'm glad you brought up resiliency because let's start talking about what are the actual hazards, how they affect logistics. There are some ways that we think about buildings as homes and offices, and they have certain resilience features almost by design, like work from home. Your office goes down, you work from home. Obviously, if your house floods, there's not really a resilience backup to that. So could you talk a little bit about the hazards that assets face and how logistics and industrial is particularly impacted by them?
We all lived through the COVID period where a lot of office-based workers just discovered the ability to work from home quite effectively. But that was not necessarily as possible for all sectors of the economy. If you had to be in person, doctors, nurses, for example, they had no choice. If you think about industrial and logistics facilities, this might be trucking, it could be food storage, cold storage, it might be manufacturing. They don't necessarily have a choice of doing their work remotely. You know, if a big storm comes in and cuts off road access there, that facility, that business is going to suffer. Or if you've been mindful and you've planned and protected yourself against some of these impacts, you might be the business that continues to flourish, even when the physical impacts start to occur. So I think there's a real risk there, a greater risk in industrial logistics to say if you're not prepared, that you might suffer more extreme downturns or extreme impacts. The UK is a great example. Aussies love to bag out the Brits for rainy, cold weather, but guess what? It's unfortunately getting hotter at certain times of year, and there's facilities that might suffer if the equipment is not built to withstand those higher temperatures. So have those buildings been built with insulation in mind, with air conditioning in mind? Has the equipment been sized and specified appropriately to deal with the changing climate, the heat stress that we might not have historically thought of being particularly relevant in a particular part of the world, but going forward, it may become more relevant.
That's right. One of my professional activities is to publish design temperatures around the world with ASHRAE, and in Australia, it's IRA. One of the things that helps give us a good indicator of where the general climate is, something called a climate zone. And what we've noticed is that the climate zones are moving, not only because of urbanization, but also just if you see water climate zones expanding away from the equators into the temperate zones. So your point about buildings that were designed and our mentality around certain climates being heating dominated or cooling dominated in a way. But then when it starts to flip to the other side, then problems start to occur, which is an irony, right? In Australia, you expect heat, so you plan for it. In Britain, we don't expect heat, so we don't plan for it. So we actually fall over at a much lower level of hazard.
This is where I would say that there's no substitute for local data. I'll use an example of Singapore. It's a tropical climate. It's hot and it's wet most of the year. And if you look at climate risk modeling into the future, no surprise, it's going to continue to be hot and it will continue to be rainy. So probably what is happening now in terms of building design and function, it might need to be tweaked a little bit, but probably not fundamentally changed. What is perhaps most interesting to me and some of our clients is when they start to spot things that are not what they're expecting. A hot climate that suddenly becomes much rainier or much wetter, storms that intensify or migrate north or south, depending on where you are in the world, heat waves that last for longer, or you have more significant summers or even deeper winters too. Parts of the US, for example, where major snowstorms come through. So there's a need to plan accordingly around some of that, changing in capital planning, changing in operational practices as well.
Yeah, I think what we've been talking about a lot is what the climate does. And so the climate is what it is. You don't change it, you experience it. When a weather event becomes a disaster, the economy is involved. So it is very, very important not only to have good localized weather and climate data or hazard data, but also to figure out how it interacts with your specific assets. Can you talk a little bit about what an owner and operator should be thinking about in terms of first assessing their hazards on a per asset basis, as we've said a few times already, and then to think about how to design for them? Should I allow for a little bit of failure, or should I design no matter what?
Maybe the first comment there is that risk is never zero. That's true for climate risk. It's true for all sorts of risk. And investment in many regards is that balancing of risk and return. I don't think people should look at climate risk all that differently than how they look at other risk factors and say, is this something that fits my risk profile? Is it something that lines up with my investments or my operational strategy, my business? What do I need to think through in terms of capital planning and whatnot? And let's say somebody who's looking to buy an asset, and they might ask the question of what are those risk exposures look like in Sydney? A lot of that is around flood risk, rainfall risk. So you can use technology to get that answer in a matter of minutes, often, to be able to model, today and into the future. And the first thought that I would have is, what does that client plan to do with the asset? Are they going to hold it in a core fund, maybe forever or for longer than 10 years? Is it a value add fund where they might be buying the asset, doing something to it and changing hands in a few years' time? And that starts to shape the thinking about risk. So risks might be much worse in any location 100 years from now, but that's not that meaningful if you've got an investor that thinks in 3 to 5 year return cycles. That asset's going to be long gone and they're going to be long gone. Where it starts to line up is where those elements interact with each other. You're going to hold it for a period of time. There's risks that might be slightly elevated now. What should you do next? Again, risk is never zero. So that decision might fall down to, does the asset need to be repaired or maintained any differently than it is today? Does it need a roof replacement a little bit sooner than it might have otherwise done? If a flood happens, where does the water go? Or are the drainage and culverts and whatnot, are they all appropriately designed and sized? It could also be a conversation. If you're a landlord, there's a risk transfer that goes on when you sign a lease with industrial properties. Typically, you're passing that risk onto the tenant. So the landlord might say, hey, there's a bit of risk here, but the way that we've structured our lease protects us from the worst of those impacts. Now, the tenant also has that opportunity to form the view there as well. So I think the smart tenants and landlords are looking at the asset to say, what are the risks I cannot accept? In which case I either walk away, that doesn't happen very often, or do I physically or operationally do something to mitigate? And then we get on with it. 9 times out of 10, when we've done these analyses, probably 99 times out of 100, in fact, clients go ahead with the deal. They say, we understand the risks better now. We've been able to price it accordingly. We build it into our capital plan. From an institutional investor standpoint, their investment committees are quite sophisticated. So they're already looking at assets that they think there's a good chance of being able to balance that risk and return. And climate risk just becomes one more decision-making factor.
I think sometimes there is a perception that physical climate risk is somehow this new thing I have to consider. But actually, I think you broke it down perfectly. Climate's always been there. The risk has always been there. We have now data to accommodate that risk-based decision making, which is something investors already do. I'd like to close this conversation with getting some of your thoughts around logistics and industrial, even though it's happening slightly out of sight. We are all benefiting from this explosion of logistics and industrial as consumers, and it's becoming sort of the backbone of global commerce. whether it's large warehouses holding boxes or cold chains. What is the role of resilience in the investment decision making for logistics and industrial? Is resilience something people should already be thinking about in their investments? Will it create winners and losers?
I think there's opportunity to put your head in the sand and try to pretend this isn't real, or there's an opportunity to say, actually, data is quite accessible these days. This information is quite powerful. I can use it to shape my decisions and make better decisions. Where I think it does get a little interesting, and there might actually be winners that rise above, is that those who interpret the data and then do something even more creative with that. I'll give you an example where planning regimes around the world tend to be a little bit retrospective. For example, it might have been, hey, this is how buildings should operate based on the last 20 or 30 years, as opposed to saying, this is what we think buildings will need to look like for the next 20 or 30 years. So the forward thinking people that take this information say, here's how I make an even more resilient asset. It might be better insulating an asset in a heat prone area, installing firefighting equipment if it's an area that's prone to wildfires, looking at drainage and whatnot in flood prone areas. This might not be a major cost factor if I do it from the start. And it might be something that people kind of question, is this really necessary? 10 years from now, you might be the smartest person in the room. So I think that's where there's an opportunity to think about it through a longer term lens around value creation.
And with that, that's about all the time we have for today's episode of The Pulse. Thank you, Matt.
Thank you very much for having me.